But before we start with the mining panel, let me say some words on TradeWind and Fraser Buchan, who is the co-founder. TradeWind Markets provides a digital solution for the physical precious metals markets through their combination of a world-class exchange technology with a tailored blockchain application to revolutionize the trading, settlement, and ownership of vaulted precious metals. They are building a new ecosystem for all market participants and will make trading and storage safer, faster, and what is also important, cheaper. The aim is to create a better, respectively more efficient precious metal market. The first ventures initiative came through IEX Group, which is the operator of the US stock exchanges. TradeWind Markets was spun out and incorporated in April 2016. The company has already 20 employees with domain expertise in exchange technology, blockchain development, commodities trading, and sales, of course. It was funded by management and first-class strategic partners like IEX Group, Sprott, of course, Goldcorp, and Agnico Eagle, to name some of them. The electronic market and blockchain technology applications are in pre-production testing. The commercial launch has started with a network of physical gold market participants like multinational banks, physical gold dealers, and regulated investment dealers. Goldcorp deposited 3,000 ounces of gold from their Red Lake mine in March 2018 into the TradeWind boards. So the TradeWind platform can connect a diverse set of participants and enable them to interact directly and on one electronic market with one uniform post-trade system. Their technology aims to unlock efficiency in existing business lines and present new opportunities for innovation. Please welcome also Fraser Buchan, who is the co-founder of TradeWind Markets. Fraser, please come onto the floor. Great to have you. Hi, please have a seat. So then let's get started. So, voila. Oh, great. Okay, we have some lovely questions as you are used to that procedure with the mining panel here. And we want to first start a little bit more, let's say, on the general terms, I would say, and before we dive into your two fantastic companies. So, David, what was your, respectively, Goldcorp's motivation for sponsoring TradeWind Markets?
Well, as I said earlier on, what we're looking to do is broaden the distribution platform for our product, and TradeWinds provides another more cost-efficient platform for doing that removes the need for bullion dealers to do the work for us, which means better price discovery and much lower transaction costs. So there's a bottom line impact that we can realize quite immediately. But again, broadening the appeal for gold, particularly with the advent of blockchain, is very important to promoting the product. There's no reason that we can't steal market share away from Bitcoin with a gold-backed digital currency. The thing about Bitcoin is it has the illusion of finite quantity, but it really isn't. I mean, it's only backed by zeros and ones. There's nothing to say that 21 million coins can't become 28 million coins. It's a fiat currency like any other fiat currency. What's unique about this currency that we're helping to launch with TradeWinds is it's backed by a finite commodity, a finite financial instrument such as gold.
I mean, this is why you have delivered the 3,000 ounces also into the vault, right?
That's right.
Yeah. So that it's real.
That was our Genesis block, and we did it in partnership with the Royal Canadian Mint, so you have the security of storage associated with that. Mm-hmm. So it's a very exciting product, and when Fraser sold us on it a couple of years ago at our Disrupt Mining event, we were immediately sold on the potential here, and we put some capital in very early on.
Mm-hmm. Wow, great. Yeah, Fraser, how has blockchain, of course, enabled your business finally, and why does it make it easier, faster, and safer to invest through your way?
Sure, so I'll make a basic statement at the outset, which is for all but the largest global institutions, trading and investing in physical metals is incredibly difficult. And by difficult, I mean it's complicated, it's expensive, there are a lot of logistical issues that need to be sorted out, vaulting counterparties, insurance, delivery. And I think in large part that's resulted in the new wave of investors, people in my age bracket not interacting with that market. It can be extremely difficult to ascertain the difference between formats, locations, refineries, and what it's resulted in is actually quite a complex market that doesn't necessarily serve the next generation of investors very well. So the opportunity that we saw at TradeWind was to use a combination of exchange technology, So creating a ubiquitous location for people to come and trade. You're not dealing with a dealer over the telephone with an e-commerce platform. It's a much more flexible and transparent ecosystem. And then connecting that to the same technology that's enabled these assets like Bitcoin, which obviously have become wildly popular. And in doing so, what we've created is direct connectivity between investors and the locations that hold their metal. In our first application, that's the Royal Canadian Mint. And we cut out all of the intermediaries that either charge a spread or charge ongoing fees. So investors can come to our market, they can buy physical metal, they can hold it in an account on our blockchain, and it's free of cost.
Wow, okay. David, how do you see the precious metal industry in general, of course? I mean, you're one of the top 5 producers, so where do you see the statues today? And haven't we explored enough for the future needs, or was there too less money to do so?
Well, with declining reserves, and they're down a third, it's inevitable what's going to happen. This is an existential threat to the industry. I think mergers and acquisitions are inevitable. It's not something that we're looking to participate in. We're quite happy with how we've repositioned our portfolio, and we're providing growth in a no-growth sector, a negative growth sector. So we've well positioned ourselves by being counter-cyclical. But these larger producers that are seeing their production continue to decline and have so for 5 years and are likely to see that for another 5 to 10 years, that won't continue in perpetuity. They're going to have to transact. And we're seeing that this year. The emerging producers, the mid-tier, are starting to consolidate so they can create some critical mass and some relevance in the marketplace and also start to diversify their portfolio, because being a single asset producer can be a very uncomfortable thing when something goes wrong with your one mine. And so diversification is important for them. So I think they're going to lead the wave in M&A, but these larger scale producers are going to have to do something to reverse the downward trajectory in their reserves and production. And given the lack of exploration success, it's inevitable that there'll be combinations.
Absolutely. I see it absolutely the same way, definitely. Fraser, how do you see the impact on the physical gold trade through blockchain, crypto gold, and your platform?
Sorry, repeat the question if you don't mind.
How do you see the impact on the physical gold trade through blockchain, crypto gold, and your platform?
Yeah, at its most basic level, I see our platform as enabling a market price that is driven by the pure dynamics of supply and demand. So with the lack of intermediaries in our marketplace, what you see are a stack of executable quotes on the buy side as well as the sell side. And what that provides is pure transparency to anybody in our marketplace, in the same way that everybody would be able to tell you very accurately what a share of Google would be worth. So I think when you look at the global physical market, that's probably the dynamic that's lacking. You can have it in isolated instances, but as a whole, it's very difficult to determine what the factors are that are actually driving the price of gold. Our market is somewhat different than other global markets in that the asset being traded is actually physical. So it's fully backed. Anybody who has an account in our ecosystem can have that physical delivered by the counterparty that they've chosen. So the Royal Canadian Mint has a legal obligation to deliver every single ounce that you own through our marketplace. That's not true of the London market. That's certainly not true of the futures market. So what we'd like to demonstrate over time is that if you actually connect buyers and sellers at a true price, that over time we'll see that the price of gold probably will benefit dramatically, and we certainly hope that will be the case.
But this price you are setting, is it then the London fix, or is it like an interbanking rate? How does it come?
It's independent, so it's driven purely by supply and demand and by trades executed on our marketplace. So if you look at a London price, that's determined by the 5 clearing banks, the LPMCL. At the end of the day, they aggregate all of the business that they've executed within their silos, and they agree on a sort of ending price that approximates all of their business. Our market is completely different in that the price is driven by executed trades. There's some nuance into how that actual reference price is delivered, but you can be assured that somebody either bought or sold metal at that price.
Interesting. So that means that we do not look in the future on the COMEX, we look more on your platform because that's the real price.
That's right.
Yeah, I mean, the London fix is an anachronism. It's opaque. Nobody really understands how the prices are fixed. But trading on the blockchain is extremely transparent. And it also helps us track the provenance of our gold. And we're going to start to differentiate our products. I mean, consumers of our gold are going to demand that we deliver ethical gold to them. They'll want to know where the gold is coming from, where it was mined, where it traded hands, to ensure that it's clean gold. Much like we've seen in the diamond industry, that's inevitable in the gold industry as well.
Wow. It's getting more and more interesting, Jesus. Well, David, has the general trend of the Industry 4.0 with its high degree of automation reached the mining industry yet?
Yeah, it's coming, and we're seeing that more on the artificial intelligence side, the Internet of Things, as I alluded to in my presentation. For example, right now we're piloting tele-remote mining or semi-autonomous mining at our Musselwhite mine in Northern Ontario. A third of our production is now derived from machinery that's operated 400 kilometers away in Thunder Bay, where most of our employees live. What that allows us to do is remove their travel costs out of our budget, remove their camp costs, and allows us to run our equipment during changeovers, shift changeovers, and during the blasting cycle when typically you have to evacuate underground mines. So it's vastly improving the efficiency of our mines, and we're going to see that rolled across our Canadian portfolio over the next couple of years entirely. I foresee a time when we have very few people underground other than the occasional mechanic to make sure the equipment is operating properly.
How do you see maybe also a trend like, let's say, electrifying your scoop tram or stuff like that?
Well, in fact, we have the only fully electric mine in the world in Northern Ontario at the Borden mine, which is being developed currently just outside of Timmins in our Porcupine complex. And what we found is, one, it's more efficient. We're getting better lateral development from that equipment than we expected. It generates much less heat. Much less emissions, which means we have to ventilate less. We don't ventilate, in fact, at all. So it's really driving down our operating costs. So the efficiencies are immense, and we see the potential to roll this out to the entire fleet over time.
Okay, so that would result in a lot of further cost reductions, right?
Outside of labor, energy is the other big cost driver in our business. Fortunately, 70% of our production comes from underground mines, so we're not quite as diesel intensive as some of our competitors. But it has the potential to really drive down energy prices quite dramatically, or energy costs as a component of our overall costs in the industry. There are some technological innovations in general society that have developed at a very rapid pace over the last couple of years that are easily adoptable in a controlled environment like a mine. Think about driverless technology. Think of the complexity of having a driverless car in the streets of Zurich with variables like pedestrians and street lamps. But in a controlled environment with few people and few of those impediments, it's very easily adoptable into a mining setting. And we're going to see the advent of that in a very rapid fashion in the mining industry over the next couple of years.
Well, that's interesting developments here. Fraser, what is the value proposition of using the blockchain technology to buy and sell physical gold?
I think the single most important attribute of blockchain technology is that it creates an immutable link between the owner and the vault in our case. So to go back to our existing offering, the Royal Canadian Mint actually recognizes our network of accounts as being the source of truth for metal in their vault. So what that means is that if you have an account on TradeWind, you can actually go to the Royal Canadian Mint and demand physical delivery. You do not have to go back through a network of dealers who may or may not honor that equation. So I think that that's probably, in its current iteration, the most important feature of our technology. As we move forward and we expand the scope of our technology, the one that interests me the most, I think, is really in payments. Is if you create connectivity between all of these different parties, and that can be banks and institutions that trade physical, and it can also be investors who hold it on a commercial basis. What you can enable is actual transfers in wealth, in payments and remittances in physical gold. That treads on a totally different ecosystem, being money transmission. So in my world, that's FinCEN and FinTrack, but certainly we would see that as being a logical progression of our platform.
Okay. Yeah, let's move now into your companies a bit more specific, I would say. And I want to start with Goldcorp. In your presentation, as we just saw here, you emphasized, of course, the 20-20-20 strategy. As this is unique among the mining companies, David, can you tell us a bit more about the strategy, of course, and how it combines the growth side with the shrinking costs? And also maybe, can you give us, maybe a direct practical example how you can achieve the reserve growth of 20%? Because, I mean, we were just talking in the TV interview, reserves is not resources, so it's much more dense drilling. You have to do much, much more work and invest more money, of course.
Yeah, I mean, when I joined Goldcorp in January 2016, I inherited a couple of distinct competitive advantages, a portfolio of good mineral endowment. In fact, I would say a portfolio of assets that were significantly underexplored. We had just exited a significant capital investment cycle where we built 2 major new mines in Quebec and Argentina, each for about $2 billion. So I had the distinct advantage of inheriting these projects when they were built out, commissioned, and I was given an opportunity to optimize them, to wrinkle out the operational inefficiencies within the system and drive costs out of it. So we were about 2 to 3 years behind our competitors in that regard, simply because our competitors stopped building 2 to 3 years before we did. And so we're playing catch up in that regard, and that's why we're demonstrating a significant downward trajectory in our costs. But each of these assets also have an opportunity not just to cut costs, but grow their production profiles organically for very little capital investment. In fact, over the next 5 years to deliver that 20% growth in production, we're only investing on average about $300 to $400 million a year of growth capital. It's quite insignificant. And so that production growth is really low risk in terms of the financial commitment, the technical risk, because much of it is brownfield in nature. And that production growth is helping to drive down our all-in sustaining costs through the economies of scale and the production growth. The more challenging element of 2020, as I said earlier on, is where's that reserve growth going to come from? It's very unique for a mining company to put that kind of target out. And when we restructured the organization, flattened it out a couple of years ago, I brought in Paul Harbidge from Randgold, where he'd been for 15 years, to completely restructure our exploration focus and make our mine managers responsible for generating targets at their mine site. And Paul has introduced a level of discipline in terms of our target generation that's allowed us to give us the confidence to inflate our exploration budgets again. We have high quality exploration targets in very prospective districts, and we already know where much of that reserve growth is going to come from. We just need to complete the drilling, and we need to complete the economic studies to demonstrate the economic viability of those additional ounces. But we know where there are, and we have a very good portfolio, a diversified portfolio to deliver that reserve growth over the next couple of years. The good thing is none of that reserve growth of 10 million ounces that we're targeting has been incorporated in our mine plans yet, because we don't know precisely where the ounces are coming to come from. But when they do come in, we're going to go through multiple iterations of optimizing the mine plans. And what I would say to you, if we deliver on that 10 million ounces of reserve growth, our production growth is going to be more pronounced than what we've advertised in our 2020 plan.
Great. Fraser, can you explain us a bit more in depth the term supply chain technologies?
Sure. So I'd make an observation to begin with, which is we're witnessing a dramatic change in the operational practices of some of the largest gold trading institutions in the world. Scotiabank is probably the easiest example of that. Scotia's the largest physical trader globally, and they are basically pulling back from all of their refining relationships in large part because they've lost track of managing the primary source of much of the material that's flowing through their bank. Obviously, that's unacceptable for a large regulated institution. From our perspective, that presents an interesting opportunity because there are really 2 attributes of blockchain technology that lend themselves very well to a solution. The first is that the technology is decentralized. So there's no single entity that can change the information that's contained in the blockchain. And 2 is that it relies heavily on encryption. So once information is put onto the blockchain, that could be Goldcorp recording production information, or it could be the Royal Canadian Mint simply recording ounces. It becomes incredibly difficult for that information to be changed. So what we would like to do, and what we're in the process of developing, is anybody who's purchased gold through our network, through the exchange, will actually be able to take an independent view into the blockchain provided by ourselves and by the depositories that will document exactly where that material came from. So it could say it was produced at the Red Lake mine on this date, it was delivered to the Royal Canadian Mint, it was refined on this date, and you can reliably trust that the material that you own has come from reliable sources. And I think from Goldcorp's perspective, that creates an opportunity to offer a differentiated product. Because very clearly in the market, there are two different prices. There's a price for ethically sourced material, and certainly there's a price for material that you've lost track of the provenance of. And so we view that as a really big opportunity for the large mining companies like Goldcorp, which obviously exhibit the best operational practices, labor standards to capitalize on.
Mm-hmm. Okay, but what happens then with the gold which has not the chance to deliver such, let's say, precise descriptions from where it is from?
Well, we're already seeing the results of that. So to go back to the Scotia example, they bought about $3 billion worth of physical material through a refinery in Ohio called Elemental. It turned out that much of that material had been sourced illegally through a network of distribution points in South America. And once the market recognized that that material did not have clean provenance, there was a huge dislocation in price. It ultimately resulted in Scotia attempting to sell the business, and it's resulted in a large dislocation between what remains as LBMA good delivery and what is now known to be inferior. So we view that as being, a very significant margin, up to 5% if you look at the way that the market is currently valuing this different material.
Okay, so Trump will not use it to fill up Fort Knox?
Yeah.
No. Okay. David, I want to touch again onto a little bit more on the exploration side, because I think this is, as you said, we said it already this evening, this is very unique with your company. I saw also in your presentation, you were like seeding, and now it's harvesting time. And you are seeding again, and you want to harvest in the future. Can you tell us a bit more about this specific strategy, and also about your latest success you had?
Sure. So on the exploration side, we made a decision when Paul joined to outsource our grassroots exploration. We do have a significant internal budget of about $125 million that we exclusively invest in exploration around our existing mines to perpetuate mine lives, look for opportunities for brownfield expansion. And in the value creation chain in the mining business, the highest risk part of that is exploration, grassroots exploration. Success ratio is extremely low. It requires a different mindset than mine development and mine optimization requires. And so we decided to essentially manage that risk by taking a portfolio approach towards grassroots exploration. So we own about 15 to 20 juniors, and we've funded them through private placements, a few $1 million here and there. We have about $250 million invested in that portfolio. Mm-hmm. And now that we've created that critical mass within the portfolio, we're essentially able to cycle that capital from one story to the other. And so if Paul finds something that he's attracted to, that he wants to invest capital into a management team in a new district, typically what he'll do is sell something else from the portfolio and redeploy that capital. So effectively, our grassroots explorations become self-funding in perpetuity as a result of that portfolio. So that's and I'm not sure what success you're referencing, but we've had, I think, good success across that portfolio. It led to the acquisition of Kaminak and the coffee project in the Yukon. Mm-hmm. More recently, we consolidated two major Chilean projects through an investment we had in Exeter Resources, and their Caspiche and now Casale project have been combined into the Norte Abierto joint venture with Barrick. So that has delivered results. And in over 28 years in business, I've been involved in the construction of 15 mines. Every single one of them came out of an investment in a junior. They are the prospectors in our industry. They're better at grassroots exploration than we are. They have the right mindset for it. And what we provide is a balance sheet and mine-building expertise that marries up well with their prospecting expertise.
Oh, fantastic. Fraser, your current business model is focused on physical gold, of course. What about other metals, or generally physical assets, like uranium, rhodium, platinum, palladium? As we saw today, uranium, for example, gets another £150 million fund in London. Yeah, and I just heard from my friends in the uranium space that a lot of people are getting really nervous because Kazakhstan is putting 25% of their production in. So, can you imagine?
Yeah,
because
absolutely.
It looks like you have the perfect platform.
Yeah, absolutely. So our platform certainly isn't built specifically for gold. It's built for all physical commodities. In about 2 months' time, we'll be launching a silver product. Before the end of the year, I expect that we'll launch a platinum product as well. When you start getting into the other commodities, because our market is fully backed by the physical asset itself, you enter some logistical issues. Uranium is a little bit unique, but certainly when you get into the industrial metals, just the pure logistics of vaults and volume become a question. Actually, you run into that a little bit with silver as well. So our focus right now is really on the precious metals market. But by all means, I mean, any commodity that is sort of calling for more transparency, for easy connectivity into an electronic environment, we can enable that.
Okay. David, you have changed a lot in the 2 years since you were joining Goldcorp. So where do you still see work to be done, cost-saving potentials?
Well, as I mentioned, the adoption of some of the technologies that are available generally in the marketplace is the next frontier for us in terms of cost containment to extend that target and up the target over the next couple of years. I think that's a great opportunity. But where I see opportunity for value creation in the longer term is in our Beyond 2020 projects, so large, longer dated projects that we're bringing through the feasibility stage that are generational assets. These are 30, 40 years of reserves in each of these three opportunities and would provide us a foundation for decades to come.
Okay. So still more work to do.
Yeah.
Fraser, how safe is your technology, finally? Meaning, how and where do you store the physical gold? You said it, it's in the Royal Mint, of course. And can you give us an idea about the security standards you have for your customers? Because honestly, to me, you know, I'm not a real techie. I'm more the miner like David, yeah? And I love my physical gold, which I can touch on, and I love my wine cellar and all that stuff. But to me, still, like Bitcoin and blockchain is something I have the feeling the guy who, let's say, did the software, he maybe has a backdoor. He can pull out the plug of it.
Yeah, it's an interesting question, and it's a good one. So I would separate the answer into two components. The first is security around your physical asset, in this case being gold. That comes down to the counterparties that we've chosen to work with, and in large part why we arrived at the doorstep of the Royal Canadian Mint almost 3.5 years ago. So as a trusted counterparty for vaulting the physical gold and delivering that metal, should the end beneficial owner demand that, we think that the Royal Canadian Mint is uniquely well suited. With respect to the technology itself, it's an interesting question. What you ultimately start off with approximates an account balance as it exists today. So if you were to deposit physical gold with UBS, they would give you an account statement. I mean, that for all intents and purposes is the title that you hold over that asset that they custody on your behalf. What we do is we take that one step further, which we say, okay, well, UBS actually no longer controls how that title gets updated. We now distribute that out to a network of counterparties, one of whom would be Goldcorp, but other operators on our platform, so that if UBS decided one day to change the information contained in your account statement, they wouldn't be able to do that. So, you know, we've taken, I think, a fairly well understood traditional idea of a custodian and an account, and we've layered safety on top of it, as opposed to tried to create something fundamentally new. So I think as a final point, the temptation from the outside looking in with blockchain is to think, okay, well, this is very sort of novel technology, and how do I know that the people who are writing the code aren't sort of misbehaving? And it really comes down to that point, which is you have all of these independent parties who are ultimately authorizing changes to ownership.
Okay, I see. Let me put maybe a second question on that, and then we finish with you, David. Where do you see your technology and your platform in 5 years? And hopefully, we don't need any longer the COMEX?
Yeah, well, the futures market serves a somewhat unique purpose. I think it's grown beyond that purpose. So I think that there is a role for the futures markets, independent of anything that we do or don't accomplish. Where we see ourselves in 5 years is being one of the global markets for physical metals. We certainly want to displace the ETFs. We believe that this represents a much safer, much more direct and low-cost mechanism for investing in physical metal. And we certainly want to steal liquidity from the London market, which is a contract market, which is controlled by a small network of banks, with very limited transparency. So certainly we'd like to become a relevant global market.
Fantastic. David, last question for you. In relation to your 2 large joint ventures you have, where do you see more value creation? By the way of buying or building? Or maybe M&A?
Always building. I've been a perpetual state of mine construction my whole career. I've never bought a producing asset. The market's really quite efficient at valuing those de-risked assets. To pay a premium for them almost necessarily destroys value, unless there's some unrealized exploration potential the market doesn't see. But it's a bit like a unicorn. I've heard rumors of it, but I've never seen one.
That's right. Yeah, thank you very much, David, Fraser. Now we come to the Q&A, and Patrick, you have a microphone. Who has a question to the gentleman? I'm pretty sure Pascal. No? Yes. Down there?
Hello, this is a question for Fraser. How does dollar enter into the system? Because one, the provenance of the gold is perfectly understood, but how can you ensure that the provenance of the dollar is fine?
Sure, if I understand the question correctly, we can create a distinct provenance chain around gold that's coming from a producer where we know the location versus gold that's being deposited in different formats from different markets. Is that?
I think it was about the dollar.
The question is only, you have to pay for the gold you buy. You pay in dollar.
Oh,
and
correct.
from where does the dollar come from? Also from South America or not?
From heaven.
Oh, okay. So, sorry, for trades that are executed on our marketplace, how is the cash leg managed? So it's no different than other physical markets in that it's a bilateral settlement. So to use a simple example, if BlackRock were to buy gold directly from Goldcorp, the gold leg of the settlement would be managed on our blockchain. So Goldcorp would transfer ownership from their account on the blockchain to the account of BlackRock on the blockchain. And then the cash settlement would be DVP. And currently we quote our market in two currencies, CAD and US dollar, but over time we'll increase the scope of currencies that you can trade against.
Great. Next one, there's one here.
So just a question on how you're going to make money from TradeWinds. You said that you're doing it for free. So how actually are you generating the income to cover the, admittedly, only 20 people you have working there at the moment?
Sure. So we charge trade execution fees, and we have two tranches. So at the wholesale market, so for trades that are being executed between parties that are directly connected into the exchange, we charge 1 basis point per side in notional value. For institutions that then open accounts for end customers, so a simple example would be a dealer like Kitco, if people are familiar with that name, we charge a sliding scale based on volume. But at no point does TradeWind capture a spread. We don't act as a principal to trades. We're not an intermediary. We'll never be in between trades.
Thanks. And just as a follow-up, how big is the sliding scale? Because 1 basis point on 3,000 ounces doesn't seem to get you very much.
Yeah. So for a trade of 3,000 ounces, we would categorize that as institutional, and we charge 5 basis points.
Thank you.
Okay. Question?
We haven't touched upon the political risk, and with everything that's going on in Indonesia or DRC and so on, what do you see in your countries of operations, and how do you ensure that nothing bad is going to happen with your company, be it increased royalties or taxes and so on?
Well, there's never any absolute certainty, even within Canada. Some provinces have demonstrated an ability to raise taxes. It happens everywhere. But I'd say generally the tax regime in Canada and Mexico is quite stable. We do have a presidential election in Mexico later on. It's possible a socialist could get in. His comments towards the mining industry has been quite constructive. So we're not anticipating any significant changes in the fiscal regime there, but of course that risk exists. In Argentina, it's been going decidedly positive in that since the election of Mauricio Macri about 2.5 years ago, We've seen corporate taxes come down 10% from 35 to 25%. We've seen export taxes on gold completely removed, import duties on critical spares and equipment removed. We've also seen a tax that used to be on reserves in the ground completely removed, which completely disincentivized exploration. And finally, we've seen the labor market relaxed dramatically. In the past, under the Kirchner regime, you had a job, whether it was private or public enterprise, was for life. And we were carrying a surplus of labor within our own Cerro Negro mine site. And when Macri got elected, we immediately laid off 700 employees because they weren't doing anything anyways, and knocked $60 million out of our operating costs on a per annum basis. So, and I would say that even the workforce we have today, which is decidedly smaller, still operates only at about 20% of the productivity of a comparable Canadian miner. So there's still a lot of runway for improvement within Argentina, given the change in the macroeconomic model within that country. So I would say, given the jurisdictions we're in, we're feeling quite a bit more bullish than perhaps some of our peers are feeling within the African continent.
If I may, with a follow-up.
Yep.
You talked about increasing gold price in the future. So I guess with an increasing price, the risks are increasing for governments to want to get more out of your operations. So what kind of measures can you implement to ensure you against those kind of moves?
Yeah, look, actually, we've gone in the opposite direction. Since Paul came on and we re-baselined all of our reserves and block models, we've taken marginal ounces and downgraded them from reserve to resource. We're focused on profitable ounces above all else. And I would say there's very limited sensitivity in our mine plans to an increase in the gold price. We're not able to bring in a lot of low margin ounces back in to the portfolio. We don't have that kind of elasticity in our mine supply from our existing portfolio. So again, the focus is very much on allocating capital to generate adequate rates of return. Since I joined the company, we introduced an investment framework that demands that we generate at least a 10 to 15% unlevered after-tax rate of return using a flat long-term gold price of $1,250 an ounce.
Question, Pascal? Yeah. Sorry.
So I have a question to both of you. First to David. It's about the 20% reserve growth you aim for. So you mentioned it's a combination of brownfield exploration and takeover of greenfield juniors. But is there a certain type of mineralization your geologists like the most, or you like to develop? Or is it more about jurisdiction?
Well, actually, the growth in reserves is not coming from any grassroots or M&A. It's actually coming from exploration around our existing deposits. So we're not assuming any M&A in order to achieve that target of 20% growth in reserves. And that's the exciting part, is because then we're leveraging existing industrial complexes and generating very high rates of return for very little capital investment, because we have the workforces and the plants in place in order to process that additional ore. It might require some small incremental capital investments if we're looking at brownfield expansions, but generally those present the best rates of return.
And the other question for Fraser is, you mentioned it competing with the ETF, and my question is towards the holding cost. So like the Swiss physically backed ETF are like maybe the cheapest one, 0.2% a year. You mentioned you live on the execution fees, but what about holding cost? Maybe I've missed it. But.
Sure, yeah. So our first implementation of the technology is with the Royal Canadian Mint. And because we're actually delivering liquidity to that location, which is not a global location for trading in physical gold, we negotiated a deal that's cost-free for storage. The actual cost of carrying the first product for an investor is zero. There's no management fee because there's no corporate structure sitting on top of the ecosystem, and there's no storage cost. As we roll the platform out to new locations, that may change. So we're working with a number of different depositories in Europe and in Asia to expand the footprint of our marketplace. But that would be, in line with the physical storage arrangements that any investor would sort of have access to at this point.
Good. There's one more. Björn?
Question for David. I think we had this discussion in Colorado last year. Again, you like the building more and expanding your own properties than M&A. But wouldn't you say at certain times where companies have a imperfect valuation given the market and coming down, or under special situations like I'm saying Detour coming under tremendous pressure, 600,000 ounce producer, main for reason they had that drop. But is there opportunities your team looks at the moment when I would say a lot of gold companies are under pressure and maybe not valued correctly in the investor's eye? And if yes, what jurisdiction among your focus in the LATAM and Americas would you like the most? I'm concerning, like Agnes said, we go for Nunavut. That's our main focus. Do you have any special focus within your existing portfolio? Or is it we like to expand more because we like it, or it's valuable ounces for us?
Yes, certainly. In terms of the buy versus build question that you alluded to, and whether it's Detour or any other company out there, I do think that the market actually tends to be quite efficient in valuing these opportunities, and without naming any particular ones. And assets that are relatively built out or fully built out or de-risked generally get a fairly healthy valuation in the marketplace. And then to pay a premium on top of that necessarily destroys value. So by and large in my career I've avoided those. I try to buy assets at a relatively early stage in development after a significant geological reserve has been defined, and then we de-risk the opportunity and re-rate it in the marketplace by building it out. And hopefully growing it geologically as well and finding more in the ground than the market had realized going in. So that's where I see the value proposition. In short, it's drilling and building. That's where all the value is created in the mining business. Financial trades are really for portfolio managers, not mining companies, and generally we try to avoid those. And in terms of where we're focusing our exploration dollars currently, I would say our most prospective districts are the Coffee District in the Yukon and the Cerro Negro District in Argentina. In particular in Argentina, Cerro Negro's reserves are made up of 9 distinct veins. We've just found a 10th, a new one, that we're defining a resource on now. And we compare that to Cerro Vanguardia, which is about 600 kilometers away in the same province, operated by Anglo. It's an older mine in exactly the same geological setting on exactly the same geological trend, and they've mined nearly 60 veins. So we see the potential for multiples expansion of reserves there in a very prospective district, and that's the opportunity. In the Yukon, we bought a 5 million ounce resource under the geological thesis we could double the size. In our first drill season last year, we found 5 new zones, all near surface, oxidized mineralization, open pittable, heap leachable. We haven't even gotten to the sulfides. We've only drilled down to 250 meters, and we've only drilled or sampled about 18% of our 60,000 hectare property position. So really, really early days, and it's quite exciting. And some of our old districts are still giving more. The Century discovery in Porcupine, which is a 110-year-old camp, is the largest discovery in its history, 5 million ounces just 2 years ago. So we're still finding more in these older camps, and with the renewed geological and exploration discipline that we have in the organization, and we're generating good targets within these older camps as well.
Great. So time for one more question, I think, Patrick? No? They want to eat, huh?
Their mouths are full.
Yes.
So.
Well, there's one more. Roderick?
A question on the refining costs. If you buy through a blockchain technology, the Doré, how do you incorporate the cost for refining, and what happens to that?
Sure. So currently, the gold on our market is actually refined. So again, to go back to our first implementation, because the Royal Canadian Mint is both a refiner and a vault, we actually have a role in the refining side. So the Doré arrives at the Royal Canadian Mint. It's refined into a physical product. It's deposited into the vaults of the Royal Canadian Mint, and then they create a representation of that physical asset on our blockchain.
Yeah, fantastic. Well, thank you very much, David, Fraser. I think that's an applause.
Thank you. Thanks,
Yeah, David, thank you very much. Well done. Fraser, thank you much. Learned a lot.
Thanks, David.
And so enjoy the dinner now, and we see us in approximately 30 minutes. Thank you.